Right now, we have a lot of market uncertainty with the Iran conflict and everything going up and down and sideways. What can you buy? What can you do? In this video, we're going to be covering exactly that. I'm going to go through some defensive income ideas that will help you get paid while protecting your capital and growing it long term. Let's get into it. Now, before we get started, I do want to be clear that this isn't financial advice, but this is something that you can use to start your research, get some ideas, and highlight and come back to. So without further ado, let's go through some high risk options here. First up on our list is Gold Miners ETF. Yes, YieldMax Gold Miners ETF. If you want something that's going to pay you a lot, this is a 100% yielder. Gold Miners ETF is just that. This is by YieldMax. They hold and run an options overlay on GDX, which is the Van Eck Gold Miners ETF. And essentially, lately, at least lately, it's been doing quite well. Over the last 3 months, they're up 15%. This is the total return, so this includes the NAV plus your weekly payouts. And I don't have the chart up here, but the NAV is flat essentially. So you're essentially still holding your money, but with their weekly payouts, you are profitable, especially compared to QQQ. We also have Winter, another yield max option here. This one has a little bit different risk to GDXY, but Winter is a bet essentially against Bitcoin and also therefore against MicroStrategy. So the risk is quite different to the Gold Miners ETF, but if you think Bitcoin is going to stay down for a little while longer, why not collect some premium on it? At least as of late, it's done pretty well. I've personally been holding this one since August of 2025, and it's been one of my best performers, ironically. I wish that wasn't the case, but such is life. And yeah, you can see it's doing pretty all right. The NAV on this one is flat over the last 3 months, but it's up over the longer term. And then lastly, if you really want to get into some risk, you could go with TQQQ or SQQQ. And what these are a 3x daily mover on the QQQs. So short is the SQQQ and long is the TQQQ. And if we look how these compared to their underlying, you can see the regular Qs is down about 4%, SQQQ is up 13%, and the long is down 15%. So these are very high risk, high reward plays, but if you make the call correctly, you can make some profits. Now, I would wait on this one until you know you've got a very clear direction on which way we're headed. This isn't the best when we're choppy up and down like you're kind of seeing on this chart, but hey, it's an idea for the future. Now, if that's a little bit too rich for your risk appetite, let's talk about something a little bit more reasonable. First on our list is SPYH. And this is from Neos. They pay around 7-8% distribution rate, and essentially you can think of them like a lower beta SPY. You still have that S&P 500 exposure, but it's hedged, so you don't have as much downside, and consequently, you don't necessarily have as much upside either. So if you look at how they perform against the underlying, this is over the last 3 months of these choppy markets, they've been doing all right. You know, they've been doing a flat, I guess, compared to a little bit down with SPY. So that's one option. Another option in the medium risk category is SCHD. Now, SCHD still has equity risks just like SPY does, but you have a much higher quality sort of more safe assets in SCHD compared to SPY. You have the top 100 U.S. dividend stocks. They pay around 3.3% a quarter. And in times of uncertainty, people tend to flee away from risk assets like QQQ and flee toward assets like gold and SCHD. So if you look over the last 3 months, they've done very well, similar to gold even. They're up about 13%, which for SCHD is pretty crazy. Meanwhile, SPY is down a little bit like we saw before, but SPYH is still doing okay. And last on our list for the medium risk category is KGLD. This is from Curve. They yield much lower than the GDXY. They yield about 10% instead of 100%, so the NAV is more likely to increase over time. But I actually like this one. I have this one in my portfolio as well. They've been doing better than regular GLD since its inception, but this one's been doing pretty good too. They're up about 24% over the last 3 months, and they've been outperforming as well. Now, if that's still too risky for you and you just kind of want a place to park your money but still have it grow a little bit, this next category is for you. Let's start with SGOV. This is U.S. Treasury bills. I have a decent chunk of my funds in SGOV currently, but I like it because it's just a very predictable, very steady return, and it's also very safe because it's backed by the U.S. Treasury. Yields about 3.5%, 4%. And if we look at it compared to QQQ, again, you can see it's just flat not flat, but it's pretty slow, steady increase over the last few months compared to QQQ. And if you go back even further, it's the same thing. It's just that nice, steady savings account-like return. If you want a little bit more risk, however, you could go for VTIP. This is a Vanguard fund, and that's for Treasury inflation protected securities. And if we look at how that performs, a little bit less of a yield than SGOV, but it has a little bit more volatile performance, so it can underperform, it can overperform, depending upon what's going on with the market. But you can see, as of right now, it just crossed ahead of SGOV. And then another idea here, kind of along similar lines, is another Vanguard fund, Vcash. But this one is a Vanguard short-term corporate bond ETF. So you don't quite have that same long-term risk, but you're now in the corporate bond, you're now in corporate bonds, which is kind of its own thing. But again, a little bit higher yield, a little bit higher risk, a little bit higher reward. And if we look at how that's done over the last year compared to the other two, well, you can see that Vcash has done the best, VTIP the second best, and SGOV the third best. So I just threw a bunch at you right now. These are some ideas that you can kind of play with. You can mix and match these to match your risk tolerance. But I think these are some good plays right now, especially while the market doesn't really know what it's doing at the moment. And as far as what I'm looking for the foreseeable future anyway, is I'm looking for VIX to come back down. Right now, VIX is in the 30s. I want it to be below 20. I'm also looking at the 20, 50, and 200-week moving averages for QQQ and Bitcoin. These are important to me because the daily, if you look at the daily moving averages, it can be kind of easy to get caught up in a fake move or a spike and a fall. So I like to look at the weekly moving averages just because it tends to give me a little bit more smoother peaks and troughs, which is something that I appreciate. And the last thing I'm doing is following the trends. I'm not trying to time the top or time the bottom, at least not with the majority of my funds, certainly. I'm really just following the trends. I'm riding the wave down and riding the wave back up. So hopefully this gives you some ideas as far as what you can buy today in these choppy markets. I'll keep you updated on the situation as we move forward, but hope you are having a good week, and we'll catch you in the next one. Take care.